The first speaker up will be Jaeger of Lazard. Jay's Managing Director and Portfolio Manager leading the Lazard multi-asset investment team. Prior to joining the multi-asset investment team, Jay worked in a number of areas within the firm, including global risk management, fixed income and quant technology. Our second speaker will be Ralph Jaeger of Siguler Guff. Ralph is Managing Director at Siguler Guff and is the Portfolio Manager of the firm's emerging markets multi-manager offerings and a member of the investment committees for the firm's Brick and Gem Opportunities Funds. And rounding off the session will be César Cuervo of SURA. César is a Director of Research at SURA, a Colombian-based asset management firm with over 16 years' experience in financial markets. César has been involved with the Latin American capital markets throughout his career. So with that, I'll turn over to Jay.
Thank you, everyone. I appreciate the time to share some thoughts with you. So I thought I would start off just by a quick summary of the past, and no one can probably be expected to read all of the text on most of these slides, so you're forgiven for that. I'll point out a couple of things about this. If you look at the ride that investors have taken since the index inception in 1988, it's been, if you were to just draw a straight line from the beginning to the end, you would have received about an 11%, 10.8% annualized return with about 22% volatility. And that's come in fits and starts and the booms and busts. It tends to be the case that people remember the emerging markets by the crises. No one really remembers the standard year. Everyone remembers the crisis and the sharp cliffs. But nonetheless, the overall pattern of performance has been something that's pretty positive. And when you look at some of the other fundamental reasons for it, it does make sense. Emerging markets represent not only the majority of the population, but also in terms of the resource availability as measured by land mass, it dominates. And over the last 5 to 10 years, it also represents more than half of the world's FX reserves and of GDP growth, energy consumption, which is another good leading indicator. But then at the bottom of this slide, what you'll see is that actually when it comes to the capital markets, it's really underrepresented. And I think that presents really just an interesting conundrum for investors, right? Because if we believe that markets are efficient, it's not a matter of saying, is this fair or not? I mean, this is actually how much money is invested in the emerging markets, right? And if it's 10% of equity market cap, why is that? So there must be some mismatch. It's not because of the return. The volatility can explain some of it, but I would say not all of it. At 22%, you're looking at maybe about a fifth higher than the developed markets. So you could say it should take a bit of a haircut for vol. But I think that there are other risks there that are inherent to the asset class which do explain some of this. And I think understanding how those risks can be addressed and what they are is what I hope to convey in the time that I have this morning. I would say that there are two. The first one is probably the drawdown impact. It's tied actually to the second one, which is entry point risk. Both of these have to do with one of the hardest risks, I think, to measure as investors, which is really what is the investment time horizon. I thought I'd quickly share a story. I think we've, as a PM, I would say that it's easier to learn from your mistakes in the end. And one of them was actually with a big sovereign wealth fund client of ours. And this was an emerging markets mandate. And it was in the Middle East, and there was this big signing ceremony, right, to sign the IMA, just something unique to that region, I would say. Big gold-doored room with a big conference room, and the royal member decides that he's going to make this speech. And in this speech, he explains that this investment is intended to outlast all of our lives. This is the future wealth of the country. It sounded great, actually, if you're a PM. You say, well, this is going to be a pretty good client. But it also starts to configure the kind of risk appetite in your mind. You're saying, okay, this is a custom sort of mandate with a very long investment horizon. And the story ends 6 weeks later when emerging markets was down about 2.5%, and it was back on a plane going back to the Middle East. The same person who said it was about the wealth of the future of the nation and all of this had basically received a statement and said to me, I thought the goal of this was to make money. You have less money now than when you started 6 weeks ago. I think that experience is actually a lot more normal than we'd care to admit. And really emerging markets is a long-term asset class, but it's, I think, increasingly being kind of projected as a very short-term asset class, and I think that's quite dangerous. So the way we tried to measure it to avoid this kind of interaction in the future was to start to look at entry point risk as a concept. And The way that we measure it, I'm just going to go through this fairly quickly, hopefully it will make some sense, is we say, well, what if you randomly started choosing entry points for a specific asset class? And we use, and I'll use this just to illustrate the methodology in the US market, just because we have the data going back for longer. But the idea is this. You set a hurdle for yourself, in this case we used 5%, and you say basically you're going to buy the index and then you're going to hold it for a period of time and then just automatically sell it and measure the result. So we start off in 1951 on a Wednesday. We use Wednesdays just because there are the fewest holidays. And then you sell it a year later, right? And each of those periods is measured. In this case, in that particular time, you made 20%. It's greater than 5. I put a little checkbox. And you basically start sampling every possible Wednesday you could have made that investment choice. And then you run, so whenever it doesn't hit the criteria, you have a red X. There's about 3,500 Wednesdays that were used in this particular study. And then you look at the overall impact. And each one of these dots represents a different experience that someone might have had over the course of the year. And so for the S&P 500, the results have been pretty good. If your goal is to make 5%, you've had a 76% chance of picking the right entry point using no skill, just randomly picking a Wednesday. I guess the skill was to pick Wednesday, right? But if you look at that on a one-year period, and you can see it's significantly better. The little black line there is just the coin toss of a 50-50. You can also do the same exercise for shorter time periods and for longer time periods, right? And so when we look at an asset class, we use this term structure of entry points, as we kind of call it internally, to say, all right, if I have a 5% target, this is basically what my investment time horizon looks like from a probability of hitting that target's perspective. And as I increase the target, same type of exercise, it becomes less likely to make the bogey, as they say. So that same chart done for the emerging markets looks like this. Right? It's significantly lower chance of hitting your 5% hurdle. And when you get even to, I think, to some of the higher return targets, you have a less than 50-50 chance. And part of that has to be calibrated by the fact that we are using a shorter time period in this one. As it says in the bottom, there's only about 1,300 Wednesdays involved in this particular analysis. So I think that when the first question about how do we structure emerging markets investments to maybe be more resilient, if we're trying to avoid the pitfalls that entry points present, I think that one very simple technique is to just expand it to be beyond equity. Right? If you have a balanced emerging markets asset class approach, you actually end up with a better result at every single time period from a probability of hitting your 5% target. It's not as attractive if you're going into 10 and 15% targets, but again, I think having a sense of that objective can help. The problem with emerging markets balance, though, is that it breaks the categories. Right? No one has an emerging markets balanced category. As an emerging markets multi-asset manager, that is a problem that we've run into a lot. And I think that what I want to spend a bit of time talking about is how important those categories have really become. The cap-weighted indices have dominated the traditional thinking of categories in general. And I wanted to share some of these insights. So in the MSCI Emerging Markets Index, Tencent is the largest stock. It's got a 4.8% weight. But if I look at the other side of the index, at the smaller companies in that index, to get to that 4.8%, you actually need to get 457 stocks. So the index is basically saying those 457 stocks are as important as one stock on the other side, simply because cap weighting was the rule of thumb that was used to construct the index. The even broader index is worse, right? This is supposed to be a more diversified index, the IMI index. Tencent's still the largest stock at 4.3%. And in that situation, you need 1,318 stocks to actually get to the same weight as Tencent in the index. And I think that people have an instinctive dislike, I think, for cap weighting. But sometimes it's not as apparent, because I think in the emerging markets, these dominant companies are really, I think, very large and quite dangerous. Now, that means that 4% of the companies, of all the companies available, have the same weighting in the index as the other 96%. I think that's very dangerous, because that's not what the theme is. That's not why you're investing in emerging markets. It's really you're investing in 4% of the opportunity set is giving you half the result. I mean, one of those small names would have to go up 300% to have a 1 basis point impact on the result of a portfolio. And I think if those of us who've owned something that's done well at a weight that we didn't like, I think that would be quite a disappointing result. And this is something that Michael had mentioned as well in terms of what you are getting. If you started investing in the emerging markets at the inception of the index, Brazil and Malaysia was almost a third of the index then, right? And so if you've just said, well, my goal is emerging markets and let someone else decide what that means, you're getting very much a Brazil, and you were getting very much a Brazil and Malaysia portfolio. Today, China dominates the index, and if we fast forward slightly to 2025, when MSCI's inclusion of the A-shares market is complete, it will be almost half of the index. And I think that there we have to ask ourselves, is this category, emerging markets, still as meaningful as it once was if it's really coming down to a few names in one country that are dominating the results? From a sector perspective, you can see as well, there's been a dramatic shift, as you'd expect, in technology. So one of the things that we can do to address it, and I'm not going to belabor this point too much, is we can start maybe moving towards, I won't call this smart beta. I think if we move from sort of dumb beta, let's call it, maybe went to university, learned a solid trade beta. It's not something super smart, but it's something you can do to at least educate the beta of the portfolio somewhat. Let's put it that way, right? That on one extreme you have an equally weighted portfolio, which is largely uninvestable because of capacity and liquidity, and on the other extreme you have got a cap-weighted index. And you can create a dial, and it's not a very complicated dial. It's one that we use in portfolio construction, where you just kind of turn that dial slowly from one extreme to the other, and find a spot where you can invest enough in small cap to actually get some of the diversification and the longer term theme that you're looking for without totally compromising on liquidity, and use that as a benchmark instead of the cap-weighted one. That's a technique that we've found helpful. Another point that I wanted to make is, as this has happened, this has been an interesting one. What this chart is showing you is the correlation between the growth versus value factor and the large versus small factor. So in English, what that means is, how likely am I going to get growth from large cap stocks, right? And it was very likely in the past, as you can see in the far left, and then it became extremely unlikely, and in the last couple of years, it started to become more and more likely, which means larger companies are providing more of the growth. Which is, I think, explains a lot of the popularity of ETFs in general because of the cap weighting. Those mega cap stocks have done very well. But it might be, I think, the beginning of time to start looking at entry points in the future where you'd expect over time smaller cap companies to come back in terms of providing some of that growth. So categorization is one of the main topics, and I mentioned something similar about 3 years ago at this very conference. I think that categorization is something that all of us have to spend more time thinking about when investing. What you're looking at here is a depiction of the Dewey Decimal System. It's something that there's a professor at Columbia University, David Weinberger, who wrote a book about this, and I'm using his example because I thought it was an interesting one. The Dewey Decimal System is the system that libraries, about 85% of the world's libraries, use it to classify books. Right? And it was invented in 1876 by Melville Dewey, who really thought that there were 10 cardinal categories of human thought, and every category had 10 subcategories. And so all books were thusly classified. And in the religion category, there are 10 subcategories, 9 of which were different forms of Christianity, and the 10th category was called occult practices, right? And every other religion. Now, if we had to revisit that categorization scheme today, we might choose something a little bit different, maybe something more inclusive. But the problem with books is that they're physical objects, right? The reason why they don't just ditch the system and come up with a new one is because then librarians all over the world have to arm themselves with little razor blades and scratch off the numbers in the back of the book and move them to a different shelf. Right? I think that in investing, we have moved beyond that. We're already in the digital age, and we shouldn't take those artifacts from the past and use them going forward in terms of investing. You can see this happening in the internet as well. For those of you who remember, what you're looking at on the upper left here is the yahoo.com homepage. Right? This was the most popular, most visited web page in 1994. And what Yahoo was trying to do was classify all of the world's 2,800 websites, or whatever it was, into the traditional newspaper-style categories. But it became extremely difficult to find what you were looking for online when you had to guess what Yahoo was using to categorize a particular website. And as obvious as it seems now, Google did away with that by basically saying, well, we'll come up with a category of whatever it is that you're looking for. So every search result page that you see in Google is really a dynamically created category for what you're looking for. And I think hopefully it makes sense. Amazon, all the categories that you see on the left side of that web page are designed for your customer preferences, right? To optimize how the world of different consumables is made so that you can actually find what you want as quickly as possible. And I think that we're still guilty in our industry of kind of adhering to the old categories because they're there, right? Everyone's investment policy statement has some buckets in it, and not that much time is spent on what the buckets really are. A lot of time is spent on what goes into them. And I think that that ends up being a much more labor-intensive process, because if the category is poorly designed, you have to spend more time shifting around within the category just to compensate for the limitations. I use just an example of this with FX markets. If we used, and this borrowed from our data science efforts, a clustering algorithm to just ignoring all other facts other than the returns of different currency pairs in the world, what if we had to imply what the categories were, right? And then we took the results of that algorithm and we showed it to a fundamental currency analyst in our company, and he said, well, yes, this makes sense, and these were the categories he came up with. He's like, well, those are illiquid frontier markets, those are more idiosyncratic frontier markets, those are conflict zones, et cetera, right? So he came up kind of ad hoc with different categories that actually, if you look at the results and correlations, were much more robust than the traditional geographic separation. And they also, importantly, if you think about something like a conflict zone, countries move in and out of the category on their own. If you have a certain allocation to, say, conflict zones, because they're great turnaround stories when those conflicts end, you could keep that allocation fixed as long as something else is handling the shifting within that category. And I just wanted to leave you with this thought. In emerging markets, we are very much trying to move from point A to point B. You're trying to invest in something that's longer term. And the number of decisions that you have to make along the way really are a matter of resource allocation for all investors, right? If I have to make every micro decision along the way from getting to point A and point B, my ability to actually navigate could be compromised. And I think one example that I wanted to share, which I thought was particularly funny, is this is from truck driving. Right? In the 70s, there was a big change in the way trucks were basically operated. The transmissions were changed because people wanted more flexibility in terms of gear shifting and things like this. And the worse this got, and this is an actual thing, this is called the Spicer 1453. This is the shift pattern in a 20-speed truck, right? That you could, now, I have to say, when I saw this, I said it would be pretty amazing to be able to handle this machine, right? Just kind of, you just feel like, you know, that really would put some hair on your chest, right? It's like, oh, I'm going to double clutch from 11th to 14th or something, right? But the problem is you're spending a lot more time mucking around with gear shifting in this, however cool it may be to be able to master something like this, when in reality, your car now is making a lot of those decisions for you because your main goal is not actually to be tinkering with the different categories of gears while you're on the main objective. So I think that categorization element, it's happened in a lot of other industries, and I think it's starting to happen in emerging markets within ours. So with that, I will hand it over to Rolf.
Thank you, everyone. Thanks, Jay. I really, really enjoyed that presentation, especially the last slide or the slide before the last slide, the shift slide. I think it's quite telling, and maybe that's what we need to embrace when we go into emerging markets with this long-term view. I don't know if you guys realize there was no reverse gear, so it's only forward or neutral. Some of the things that Jay said actually resonated with me quite well, because you'll see some of my comments kind of being teed up by him. I'm just going to point a few things out and just make it more informational and educational for this forum. One thing is the overall positive performance in emerging markets. I will talk about private equity only because that's the only thing I know. That's the only thing I've ever done in my investment career, but the theme is similar in the sense that we've seen good performance and increasingly positive performance coming out of private equity in emerging markets. The role of private equity, or the differentiation in comparison to the public markets that Jay was talking about, is interesting also when you look at this index. So Jay spoke a lot about index composition, the flawed indices or the evolution, how you invest in indices. The other thing that I will point out is the access to certain sectors in public markets compared to private markets. So sectors like healthcare, for example, or much of what is driven by the strong rise of the middle class, the consumer, is not easily accessible in the indices, generally speaking. Yes, you have a tech bias, as Jay pointed out, but you have little in healthcare, for example, or other services. And so that's also something to take into consideration when we talk about private equity in emerging markets. And then lastly, you will hear me talk a little about valuations. Generally speaking, private equity gets in earlier than public equity, so we try to find opportunities that are lower priced or provide better value propositions compared to public markets. Now, that's a crass generalization, and we can, of course, nuance it and slice it. But let me get started with my slides. The question really was emerging markets, past, present, and future. This is maybe a little bit similar to, and certainly less nuanced than Jay's beautiful slides, but the gist essentially is quite the same, where 10 years ago or more, emerging markets within the non-US market cohort accounted for 20-25% within the private equity fundraising environment. Today, this has risen to 40%. So, in other words, much of the growth in private equity activity and fundraising outside of the US, that is really coming from emerging markets. The heavy tilt or majority essentially coming out of Asia. We'll talk about that in a moment. But it's relevant, right? So if you were to think about your non-US or even non-Australia portfolio exposure, I don't think we have 40% exposure in emerging markets. The question is, should you have it, should you not have it? That's a different discussion. But certainly the relevance of emerging markets exposure has increased and is something that people should think about. What we've also seen over the last decade is a nice progression of performance across emerging market private equity exposure. So this takes data from Cambridge Associates, which is I think, very good data source for emerging markets private equity only. And what you see here is that earlier on, 10, 15 years ago, the practitioners, the managers who invested in private equity in emerging markets, did okay with a 10% performance. But as new managers and more nuanced ways of investing in emerging markets, more local, national funds, sector-oriented funds with more and more astute investors, as people have learned from mistakes, the performance has increased. So more recently, if you go back 5 years over that period, you see 12% performance. That's, by the way, in US dollars. And then just if you go back the last year, you would have seen a 17% performance coming out of private equity in emerging markets. So, you can see that the trend is up in terms of fundraising volumes, as well as it is in performance. Now, this, of course, is looking at it in isolation. The question is, what does that tell me? Not much, unless I can compare it to other markets, i.e., does this perform better than emerging markets, public equities? Does this perform better than private equity in developed markets? So let's take a look at that. And here, what you see here is they do. However, I will add a caveat. And I was reminded myself never to use data that could contradict my hypothesis when I do these presentations. So I purposefully omit that, but I will tell you that. So in a nuanced way here, if you were to take the index as a whole, the outperformance of emerging markets private equity is not apparent. However, if you are able to select better managers, so you only go into what is called the first and second quartile manager selection, so above the median, and you think you have the skill sets to generally pick in that category, then you will get compensated for the additional risk that you take and the exposure that you take in emerging markets. So that's what I'm trying to show here. So if you only have first quartile managers within your portfolio, I'm sure you won't have that, but theoretically, let's assume that you'll have an outperformance of 300 basis points or 200 basis points just if you pick a crop that's above the median. So that's sufficiently relevant, but in itself may not make the case sufficiently strong to get emerging markets exposure. So what else can we do to further increase our chance probabilities to have stronger returns, aside from just hitting first and second quartiles? Interestingly enough, within the emerging markets universe, you see that Asia not only accounts for the significant majority now of fundraising and investment activity, but also has created much stronger performance. So if you have a portfolio with a bias towards Asia, emerging Asia that is, and China being the behemoth in that context, you will have a higher chance of getting stronger returns out of your private equity exposure in emerging markets. That's pretty stark. When you look at here, 10-year figures, as you can see also here, as shorter you get into time frames, the better the performance has become. And the significant delta, however, continues to be very present between Asia emerging markets and private equity and non-Asia emerging markets private equity. So you want to have exposure to private equity in emerging markets? Yes. Mostly if you can hit first or second quartile managers? Yes. And within that cohort, you want to tilt it towards Asia so that you can maximize your chances of better performance within the private equity context. You see that here when we look at capital raised. I mentioned that earlier, but emerging Asia really comprises the lion part. So you have 70% capital raise over the past 5 years coming out of emerging Asia. And then, as I mentioned, and you saw that in the performance figures, within that first quartile fund cohort, so the best funds are coming out of emerging Asia. So 80% of those top quartile funds are emerging Asian funds. So hence the additional logic to get more exposure in that space, as opposed to having this broad global approach to emerging markets in private equity. I'm going to give you an example to make it a bit more accessible as to the type of companies that you would find in Asia, for example, in emerging markets. One of them is the one that we had access to. It's a wastewater management company, which is a Chinese-based company, had 25 plants in operation, and really benefited from a pretty difficult situation in the Chinese context where 50% of wastewater goes untreated. And the government is very aware of the problem. So there's these trends, these tectonic shifts that you see in these underlying sectors that make these companies quite attractive. When we invested in it, 25 plants, we doubled the capacity over a 3-year period. We're able to buy into this company at attractive valuations, a fraction of what companies otherwise would go for in public companies. So those are the type of deals that will support the increasing fundraising going into emerging Asia, but also show you why you're getting this very strong performance coming out of the emerging Asian private equity markets. Another interesting observation that we made when we look back at how emerging market private equity has evolved is not just Asia in that context that provides more attractive performance or the ability to hit better performances, but is also driven by fund sizes. Smaller funds tend to outperform by a lot than larger funds. Also here you see that is more and more pronounced in the more recent past. So while this wasn't so much the case over a 15-year period, arguably there weren't that many smaller funds, so the cohort is a little less. Now that you have a lot more small funds that you can choose from, those are the ones that you want to have exposure to. Those are the ones that you want to find. They're sector-specific, they're more country-specific, and allow you to create and design an interesting investment strategy in emerging markets private equity. You see that depicted very strongly here, where you have between 500 and 1,000 basis points of compound outperformance from the smaller fund cohort compared to the larger fund cohort. And it's oftentimes synonymous also with fund generations. Those of you who are familiar with private equity in this room know that we go by Roman numerals, Fund 1, Fund 2, etc. And then Fund 7, Fund 8, oftentimes it's not the same team anymore. But what we've observed really is there's a significant drop in performance as you increase the Roman numeral number behind that or in front of that fund name. Often synonymous with fund size growth. So the funds will tend to get too large too fast. And so the investment strategy that a team needs to implement with a fund that's 3 times or 4 times the size compared to the prior fund is totally different. And the team may no longer able to properly invest that capital. Also, you have a situation of scarcity of investment opportunities when you start hunting for larger companies in emerging markets, meaning that you're going to pay prices that are significantly above those prices that you pay for smaller companies. And finally, you have more difficulties finding the right window to exit companies when they're very large. Yes, you can tap the public markets, but you have windows in the public markets that are still quite short, and you really have to be knowledgeable as to when to hit those. You can't sell them that easily anymore to trade buyers or to other financial buyers or private equity funds, as opposed to when you have smaller companies. So it gives you just a broader array of selling and exiting these companies, which in turn helps your performance when you're a smaller fund manager. The problem is that you have these fund managers who grow very fast, and so when you actively monitor a portfolio of managers within your designed emerging market strategy, it also means that you're going to have to rejuvenate, if you want, or change your strategy frequently in terms of what manager you're comfortable with, what new manager you want to back now, where's the sector of interest. So it's a very active monitoring and investment strategy in private equity that's required to actually get you the type of performance that you can obtain, but it's not easy. It's not just a fire and forget, you just have private equity and it's going to take care of itself for 10 or 15 years. That's not the approach, at least based on our observation, that will work in the emerging market context. What else do we observe? What has changed over the last 10 years, 15 years? I mentioned some of these things already. So we see a lot of increasing nuanced opportunities, which is interesting because you can express conviction much better than you were able to do 10 or 15 years ago. So we see sector-focused funds, as I mentioned. Healthcare is an interesting space, especially in Asia and in China right now, where your survival rate, your 5-year survival rate in cancer is a third of that of the US patient, usually. There's no reason why it should be. The only reason is because they don't have access to proper medication. And so we're looking at trying to tap into that opportunity, buying into companies or fund managers who really design and developed drugs for the local market at a fraction of the cost that they use in the US. We're not reinventing the wheels. The same type of stuff that already works, like Me Better or Me Too type products for the Chinese market. So there's a huge demand here in China with the Asian population. We've seen a very, very big change in venture investments and in the venture ecosystem, which we like, and that's a result of the strong growth. Jay showed Tencent, Baidu, Alibaba. Those behemoths in Asia have really transformed the ecosystem. What I mean by that is that they're active buyers and participants. There are a lot of people coming out of these arguably extremely well-run organizations going into either funds, looking to create new companies, into managerial roles, into new companies. So you see a lot of this entrepreneurial animal spirit now in Asia in that venture ecosystem, which is very attractive. For us, presents great opportunities to buy early into these type of companies and then sell them to Baidu, to Tencent, to Alibaba, who are active buyers of these type of companies to increase what they're doing. Hot sectors will remain hot for a while, we think. I mentioned healthcare, I mentioned technology, I mentioned venture capital. So it's not cheap. It's not cheap, but it stays its course, and you see valuations quite resilient in that space. And the other observation, which is really stark apart from China, is that Southeast Asia has become a very attractive investment destination also for us, benefiting from the issues that you're currently seeing also between the US and Asia, but the creation of an ecosystem around China where the Chinese practitioners and investors are really scouting for opportunities, something that we very much benefit from. So it's not just China, it's also increasingly Southeast Asia when we talk about private equity in emerging markets. Elsewhere in emerging markets, Latin America, and I won't steal César's thunder, he'll talk about Latin America more, is an interesting market, but not for the faint-hearted. It's very volatile. It presents interesting entry points when you are at the bottoms of cycles. It's a very cyclical and volatile environment. We've identified distress situations that we quite like there, but overall, the majority of our capital is not geared to going into Latin America. And Brazil, by the way, in our view, plays the most attractive, or is one of the most attractive markets in Latin America. Central and Eastern Europe, challenging in many aspects. Obviously, Turkey is in the news almost daily, so not one that you necessarily want to have exposure to right now. Russia, pretty much uninvestable at this point in time. And then be prepared to accept longer hold periods. A bit of a euphemism, I suppose, for you'll never get your money back. So want to be a little careful on that one. And Africa and Middle East, again, Middle East, not much talent, unfortunately, I will say, and I don't mean that in a derogative way. It's just there's not much history here in private equity investing. Markets are small, and obviously the region is quite volatile. And Africa, we were looking and we're scouting for opportunities in Africa. It's very much geared towards infrastructure and resources, something that we try to stay away, but others obviously will support that type of strategy. We try to stick to markets and sectors that are not much influenced by government, if you want. And so it's really geared towards the consumer, and we don't have a sufficiently broad market yet in the context of the African environment. Although I think we see some evolution of interesting managers, but it's still very early days. Now, this is the most cryptic and colorful slide, and I purposefully put that up because, yeah, so come and talk to my colleague Cliff Yons to have this deciphered, or to me after this. I'm not going to spend much time on it, but it goes to show you a little bit how, the value criteria, overall assessment that we apply to certain markets, and obviously, this will change from time to time, but we're very aware of how markets change. And one of the takeaways here clearly is that you see that China and Southeast Asia are, in our mind, the more attractive markets at this point in time. So with that, I want to conclude here. Thank you very much for everyone's time, and I'll hand it over to César.
Good morning, everyone, and thanks again for being here and for your interest in emerging markets. It's really enticing to see this room so crowded. So let me start by saying that we at SURA Asset Management are, by definition, an emerging markets asset manager. And as such, we have always worked on the premise that not all emerging markets were created equal. And we think there is value for those who are capable of going through all the differences between regions, countries, and securities. However, we do understand that for global asset allocators, such as Australian superannuation funds, it might be an easier approach to go with market cap. But as Jay was mentioning throughout his presentation, we do think that probably going with market cap is not the right approach. So a couple of months ago, we started thinking about how to address this issue of market cap investing. And we wanted to answer two questions. The first one is there a better way to approach emerging market investing rather than just using market cap and what the MSCI indexes are suggesting? And the second one is there any actual leverage for any edge for those local players with boots in the ground, or you should only go with the global emerging markets asset manager located in London or New York? So luckily, the very cool presentation by Jay made some of my slides useless. And of course, not so cool, but he just touched on this and how China is becoming ever more important in emerging markets. And today, Asia represents 75% of the index, and China is roughly 1/3. And it is expected to continue increasing over the next 10 years. So, of course, this raises some important issues. The first one is that when you go with a market cap approach, you're not exactly getting emerging markets, you're the whole spectrum of emerging markets. You're just getting Asia. The second thing is that when you look at the correlation of the economic reality of your members, particularly in Australia, the reason behind you are looking for investments abroad, international equity, is, of course, there is some capacity issues. You want to, the local market, probably the savings of your members have outgrown local markets, and you have to explore the world looking for different opportunities. But there is also the fact that you want to mitigate risk, because your members work, they live, work, and earn their salaries in Australia, so you want to go somewhere else looking for a way to mitigate risk in an overall perspective for the average Australian household. And when you invest in Asia, given the correlation that you have with the economic cycles between China and Australia, what you're really getting is Australia twice. So that's really a very significant issue that you should keep in mind when investing through a market cap approach. And the reality is that emerging markets are very different from each other once you understand the components. And I really like this slide because something that happens to us as Latin American asset managers is that you always get in the hallways the comment, it's all about Brazil, maybe Mexico, but it's basically the same thing. And what this chart shows you is that it is not the same thing. And we're not talking about the last 3 years where Brazil has been so out of shape because of all the political turmoil. But this is a 20 years comparison. And the risk-return characteristics between of Brazil and the rest of Latin America are significantly different. And if you look at risk-adjusted returns, I mean, my point is even more clear. So when you look at, it doesn't matter if you look only a 10-year period or you go back to 2000, you will find that risk-adjusted returns within regions in emerging markets have been significantly different from each other. So what we did was that we wanted to try a different approach. What if we try to actively select regions within emerging markets and not only going with market cap? So that's what we did for and we just put a 10% active hard cap. So we wouldn't get corner solutions in your efficient frontier. But what we found is that in those 5 different periods, each box is a different period of the last 20 years. When you go with a different approach, rather than using just market cap, you will get better solutions in terms of risk-adjusted returns. So as it turned out, going to emerging markets with a market cap approach gives you basically suboptimal solutions no matter which period you choose. Even if you go without the restriction, so there's no 10% hard cap in active weights. Of course, the solutions are a bit more extreme, but my point here is that there is a different way to approach market cap, to approach investing in emerging markets rather than just following market cap suggested by MSCI indices. So I know what you're thinking. This Colombian trickster has flown over from Colombia just to sell you back trading, right? So because we're using the past to analyze the performance of these optimal solutions. So we thought the same. Or at least we thought you would be thinking this. So we started looking for a different approach and try to think forward-looking analysis. So we have a very talented team of data analysts back in Medellin in Colombia. And we asked them, could we find a way to show that regional allocation actually adds value and enhances performance? So here's what we did. We took a myriad of variables that have some correlation with the performance of emerging markets equities. And we built 4 different machine learning tools, 4 different algorithms with different parameters on them. And then we designed a 5th algorithm to work like, so to speak, an investment committee. Because each of these 4 algorithms would suggest some optimal allocation within the 4 regions of emerging markets that I mentioned before. And this 5th algorithm, what it would do was to pick the right one considering past performance. So that's basically what we did. And what we got was very interesting. So what you see in the right-hand side of this slide is the blue line is the performance of an emerging markets fund run with the strategy that I just explained. And the red one is the average quarterly performance of the Global Emerging Markets Index. And not only we got 110 basis points of outperformance per year, But only the very interesting thing about this exercise is that we trained the 5 algorithms with the history between 2000 and 2010, and then we just applied them for rebalancing strategies between 2010 and 2018, and those were the results that we got. So I'm not telling you that we're like the ultimate financial alchemist and that we found the perfect formula to beat the markets every time. All I'm saying is that this is a very good illustration of how going with a different approach, not only going with a market cap driven approach, might add some value to the way you address emerging markets. So thinking about the second question, does being local make a difference? Is there really an edge for those who have boots in the ground? And we're based in Latin America, so this is basically something that it would be, I mean, it's just responsible for us to do this, to ask ourselves every once in a while if our investment thesis makes sense and it actually adds value to all our stakeholders, beginning with our investors. So what we did, and I don't want to delve too much into detail about this because we're running out of time, but basically we went through different databases with the performance, long-term, short-term performance of several funds who declared themselves emerging markets, regional emerging market funds. We hit some dead ends. We used different databases, but at the end what we got was we used Morningstar database. And we got 172 different funds who declared themselves as regional emerging markets. So they are specific to different regions within the emerging markets spectrum. And what we did is that we compared risk-adjusted performance for different periods of time, 1 year, 3 years, and 5 years. And we ended up finding that in 10 out of 12 different categories for the different regions that you see in the right-hand side and the different investment horizons, actually local managers outperformed global managers. So again, we're not saying that the only way to go is with local managers, but there seems to be evidence about the fact that being local, knowing the companies, having a thorough analysis process, and of course in emerging markets it is also very important to have to give a serious thought about ESG issues, actually pays off. And that's basically what we are finding. This is just a summary of the results, and as I said, in those 4 regions and the different time horizons, in 10 out of 12 of those cases, we found evidence that the local asset manager outperformed the global asset manager. So I want to finish with this slide. This is something that we have been presenting to our investors and prospective investors around the world for over the last 4 to 5 years. This is nothing but an efficient frontier, and it depicts how different regions within emerging markets are located in this relative to the efficient frontier. And we saw that, of course, some others perform better. Some perform better than others, and we thought that this deserved more research, and that's basically the reason why we started asking ourselves the question that I just explained to you, what we have been doing and what we found over the last few months of our research work. So I'll leave you with that and open the room for questions.
Good news is the questioning's been vigorous. The bad news is we may not be able to get through them all, but we'll see how we go. I might just start with one to César, and I can assure you that Colombian trickery was the furthest thing from our mind. But when in this modelling you've looked at with the local managers, what does the portfolio look like? Did you get to that stage? You need several managers in each region? Or?
Well, that's a very good question. And when we actually in the third plenary yesterday, there was this very interesting discussion about over diversification.
Yep.
And I think probably in the largest regions, like Asia, for instance, where you can have like several local experts with different investment capabilities, it might make sense to have different managers. Probably in smaller regions such as Latin America, it makes sense just to go with one that provides you with the kind of risk-adjusted return and access to market that you are looking for, and that suits the rest of your portfolio. So it is very hard to say that one solution fits all the regions. That's actually our point, that not all regions should be treated the same because of the particularities of each set of countries.
Okay, thanks. There's a couple from the floor we might be able to treat as one question, I think. So, sorry. So the questions are, how often do countries move from EM to developed? And the other one is the definition of EM seems a bit arbitrary.
Yep.
And when would you see, why wouldn't Korea for instance, be promoted?
So there's an interesting story specifically about that I'll share with you. We had a former colleague of ours who's based in Seoul. When MSCI first said that we're looking at promoting, as they call it, it's become a political organization in the end, promoting Korea to the developed stage, the finance minister had a party. And this colleague of ours was invited to the party. And at the party, he went to the finance minister and said, you know, on day one, this is going to mean such and such outflows, right? You're going from being a big player in the EM index to an insignificant allocation in world index, and so everyone's just going to basically skip the country. And then they wrote a letter 2 weeks later to MSCI saying, well, actually, Korea still has a lot of corruption, you know, we're not really ready. So, I mean, I don't think it should be underestimated how political some of these decisions are. And you saw it with, I mean, China's inclusion, the way that they lobbied for that, same with the SDR lobbying. I mean, these are kind of, you know, achievements. These are sort of almost like flagship achievements of different administrations to move their countries around. And I agree, it's completely arbitrary. It doesn't change that often. At least they've given us warning. Like in China, they're doing it in a few stages. But there's not any hard and fast rule, which is a problem.
Yeah, promotions are infrequent?
Yeah, it is very, I mean, it's very infrequent. And the other thing that I would add to Jay's comments is that it really puts investors at the mercy of MSCI or the index providers. Because we saw that happening, I think it was 2 or 3 years ago with all the debate around Peru becoming a frontier market because it didn't make the rules and didn't make the cut in terms of liquidity or some other criteria that they have at MSCI. And at the same time promoting Argentina because of all the political changes. Well, we all know how that turned out. But the thing is that we were, I was working for a different company at the time, and we were struggling trying to tell our investors, you know what, Peruvian companies are still amazing. You have some of the lowest, the low marginal cost around the world in different mining operations. This is state-of-the-art technology for producing copper or whatever, and also consumer goods, banks. We really like this, the story, the demographics, and then the negative outflows just because of MSCI's decision were destroying the value of these companies with no fundamental support whatsoever. So it is infrequent, but when it happens, it tends to have a very significant impact in markets.
Okay, thank you. Ralph, this question from the floor. Your data show that lower returns for newer, more recent private equity vintages or funds, they're lower. So does that mean we've missed the boat if we're up to Fund 4?
No, because you have a lot of new fund formations in emerging markets. So I use the word team mitosis, is a phenomenon in emerging markets which is real and quite different actually from developed private equity markets where you don't have as much at all of new fund formations. And so what this means, however, is that you need to be locally on the ground, and it goes back to César's point with regards to your information advantage when you're local, to know when these teams are coming out of existing institutions, reforming and creating new funds, and those are the ones that you want to pick then. Fund 1 and Fund 2, after that, maybe not so much, so you want to rotate out.
Okay, thank you. I think we're out of time, but there's one more question I'd like to put to the panel. Do you see a lot of impact investing in emerging markets, and is there any evidence of adds returns?
We're seeing, I mean, from our perspective, we're seeing more and more tire kicking of that, I would say. Impact investing is interesting because it's a critical mass question, right? I think that if if you get to that critical mass where enough people are investing this way, it can definitely make a difference because you can start to adjust managers or company management's behavior by saying, you haven't met these criteria. So I think that'll probably be led by the giant players and in a lot of them the passive funds. When they start to imply that, and you've seen some of those have made statements about it, if they start to actually do that, that's when it'll move the needle. I think marginal, basically you need about 20% of the float to start impact investing before it'll change companies' behavior. We've seen it. I mean, we've seen it pretty directly in some cases with companies where we own a big percentage of the float. We'll say, listen, you're being penalized for the following reasons. And if you can work with the companies, they're happy to change their behavior in some cases. Okay. So that's what I would.
And that's why private equity is actually ahead of the curve a little bit from a timing point of view, because we own the majority of the companies, and impact investing, or defined also as looking at ESG criteria, is something that's very important. It's very important not because only it's the right thing to do, but what you essentially do is you create a clean company that you can then sell to a larger company, to a multinational company, into a public market situation, and so you essentially clean up the company and make it sellable. And that's one of the things that actually informs as well this value creation, meaning that you're buying a company maybe at a cheaper valuation for reasons X, Y, and Z. Once you've had a clean company, you can actually extract a premium for what you've achieved on that scale. So it's very important in private equity in emerging markets to focus on this.
Yeah, I would just add that that's something that we are definitely starting to see more often, with companies being more conscious about the importance of addressing ESG issues. And I just would add that particularly in Latin America, we have been seeing increasing inflows from foreign institutional investors, and that has also had a significant impact on how these companies understand the importance of this. Just to give you the Colombian example, back in 2007, the total participation in daily traded volume by foreign investors was less than 5%. Today, it should be around 30 to 35%, and that gives you an idea of how important these markets have become for foreign investors, and it has I would say probably forced companies to become more aware of the importance of these issues.
Yeah. Okay, thanks. Look, I think we better wrap it up there. Apologies to the unanswered questions there. So, look, just in closing, I'd like to announce that our speaker gift is a donation to the First Nations Foundation supported by Holding Redlich, and I'd like you to join me in thanking our speakers.